For months, it seems like everyone's been asking the same question. When is the Federal Reserve finally going to cut interest rates? But just when we thought relief was right around the corner, they hit the brakes hard. So we're going to dig into why this happened, and more importantly, what it means for one of the biggest purchases you'll ever make, your home.
It really felt like lower mortgage rates were just on the horizon, didn't it? And then, all of a sudden, the Fed completely changed its tune. So, what gives? Why the sudden stop? Well, believe it or not, this whole story, it really just boils down to 3 key numbers.
So here it is, the official word that kicked this whole thing off. On March 18th, Fed Chair Jerome Powell basically said, hold up, no more rate cuts for now. The reason? They're just not seeing enough progress in the fight against inflation. Let's break down exactly what they're looking at.
All right, to really wrap our heads around this, we're going to look at 3 specific numbers that are driving this entire decision. And together, they tell a really clear story about what's happening with our economy, with global pressures, and with your wallet. Okay, number 1. This gets right to the heart of the Fed's main job, wrangling inflation. And lately, one of their most important gauges has been flashing a warning sign that they absolutely cannot ignore.
And that number is 3%. Now, I know what you're thinking. 3% doesn't sound that scary, right? But for the Federal Reserve, oh man, this is a huge red flag. This is the direction their favorite inflation index has been heading, and it's making them pretty darn nervous.
So what's this index we're talking about? It's the Personal Consumption Expenditures Index, or PCE for short. You probably hear a lot more about the CPI, right? The Consumer Price Index. But trust me, the PCE is the one the Fed really has its eyes on. It tracks the prices of things we are all actually buying.
So why the obsession with PCE? Well, it's because it usually runs a little cooler, a little lower, than the CPI that you see on the news. So when even the PCE starts creeping up towards 3%, that is a major problem for them. It's a sign that this inflation fight is a lot stickier and far from over.
Okay, so that's what's happening here at home. But the Fed doesn't operate in a vacuum. They're also looking overseas. Which brings us to our second number, and it reveals a massive global pressure that's pushing prices up for everybody.
$100. That's roughly the price for a single barrel of crude oil right now. And to put that into perspective, just a few months back, it was way down, closer to $60. That is a massive, massive jump that sends shockwaves through the entire global economy.
So what's going on here? It's pretty straightforward, cause and effect. Geopolitical turmoil is messing with oil shipments, and bam, prices shoot up by over 50%. And here's the kicker. When energy costs more, everything costs more. It's not just paying more at the pump. It's higher shipping costs for your groceries, and it even makes things like plastics more expensive to produce.
And hey, don't just take my word for it. The Fed chair himself, Jerome Powell, he pointed right at this oil crisis as a huge reason for their concern. It's a major factor in their decision to just wait and see instead of moving forward with those rate cuts.
Okay, so let's recap. We've got stubborn inflation at home and this huge oil shock from abroad. Our third and final number is where the rubber meets the road. It shows how these 2 big forces are hitting the housing market and, well, your bank account.
6.25%. After that brief little dip we saw, this is the new reality for a 30-year fixed mortgage. And the big takeaway here is that the dream of those sub-6% rates, yeah, that's been put on ice, at least for the time being.
And man, the whiplash on this has been wild. I mean, think about it. End of February, we finally saw rates dip below 6% for the first time in over 3 years. It was a huge deal. But then, boom, the inflation news hits, the oil crisis gets worse, and just like that, rates shot right back up. When you see it on a chart, the reversal is just wow. You can see that little moment of hope, and then that sharp spike right back up. And look, that little quarter-point jump might not seem like a lot, but it really adds up. On a typical $400,000 loan, you're talking about nearly 60 extra bucks a month. Over the life of the loan, that's over 20 grand. That's real money, and it's definitely enough to cool down the spring housing market.
So we know rates are up, making it more expensive to buy. But that's just one piece of the puzzle, right? To get the full picture for the spring, we also have to look at inventory. You know, how many houses are actually up for sale. All right, so at the end of February, there were 928,000 active listings out there. And yeah, on the surface, that sounds like a ton of options for buyers. But that number needs a little bit of context.
Let's break that number down a bit. We're still just a little bit below where we were before the pandemic.
And while inventory is up about 8% from last year, which is great news for buyers, don't get me wrong, the growth is starting to slow down. So, the bottom line? Yeah, you've got more options, but it's not exactly a free-for-all buyer's market out there.
So, what does all this mean for you? Well, if you're a buyer, the good news is you'll have more to choose from than in the past few years. The bad news? Expect a fight for the really good homes. You have to be ready to move, and move fast. And for sellers? Well, the market's a bit more crowded now. You've really got to do whatever you can to make your place stand out from the competition.
And that really leaves us with the million-dollar question, doesn't it? We've got more homes for sale, but it costs more to borrow money. That's the big dilemma for anyone even thinking about real estate this year. And honestly, there's no easy answer. It's really going to come down to what's right for you and your own situation.